Folks, ouch. Here's what's been happening, and it's quite painful. There was this idea that was being spread around in analyst firm after analyst firm at all levels of Wall Street, in government, and so on and so forth, that you could just keep eating into endlessly the purchasing power of consumers. But no matter how much money you print, if the wages aren't keeping up with inflation, well, that just doesn't happen like that, right? That's just not how math works. And today you saw some of the most concrete evidence of that we have seen so far in this cycle. Walmart didn't even have an earnings date this week. Their earnings is in August 16th to be exact, but they felt so compelled to update their shareholders because things changed so much, and they came out and they dramatically cut their profit forecast, and the stock dumped like a barkless dog. You kick little Fido and you're like, Fido, are you still alive? And the dog doesn't bark, it doesn't make a move, it's just sitting there lying on the ground dead. Now, for folks who follow this channel, an 8% move isn't very much, right? It's not that big of a deal, but for a stock like Walmart to drop 8% on an emergency announcement nonetheless, is kind of like a tech company dumping 60%. It's a big stinking deal for the top, most core consumer defensive stock in perhaps the world to see this kind of hit. Apparently, the Walton family fortune fell about $13.5 billion because of this hit. The good news is, though, that the wealth gap is closing in quite a lot. Talk about effective policymaking. I mean, you can't have a wealth gap if you have no wealth in the economy. And then when they complain about a recession, we'll say, hey, there's no such thing as a recession. Can't have a recession if you get rid of the word. What did Walmart say? They said they see full year earnings taking 11 to 13% compared to the prior estimate of just 1%. Taking from 1% to now 11 to 13%, that is a dramatic shift for such a massive company with such a big impact. They see the consumer going into financial preservation mode. They said the increasing prices of food and fuel are affecting how customers spend, and they are anticipating even more pressure on general merchandise in the second half of the year. Again, this was not supposed to happen. We were told again and again, no, consumers have more money now than ever before. No, consumers are doing healthier than ever. No, consumers can pay increased prices. No, this is the best economy in the history of the United States. No, you were stupid if you were feeling pain. You are wrong. This is the best economy ever. Anybody that says differently is trying to spread a conspiracy. But again, when you see reports like this, it suggests the complete opposite. Right now, the fact of the matter is, and what Walmart is saying, is that inflation is gutting the consumer like a dead carcass. Demand is dying rapidly, and there's another story emerging here too. Walmart actually said they're going to be reducing prices to clear out the merchandise that they still have. You look at the inventory of general merchandise across the economy, companies are stacked up way above average as we head into a weakening consumer, which suggests what? Well, it suggests deflationary pressures in consumer goods are coming very rapidly, which is something that we've talked about before, and we know about this. A lot of companies overstacked up to fulfill what they thought would be endless demand, and now all of a sudden, guess what's happening? They don't have endless demand, and they have to go and offload at lower prices. Now, before you get really excited and say, Charlie, that sounds deflationary, and it is deflationary in some extent, keep in mind that the hottest pricing pressures right now are from the food and energy segment and overall precious commodities. If Barbie prices go down, if the price of pots and pans go down, that is fantastic. Sure, companies have a lot of excess inventory to unload, but the areas of the economy that are the most painful in terms of inflation, the ones that are crucial for survival, and the ones that the Fed basically has no impact on, well, companies don't have excess inventory of those things, of perishable food, of precious commodities, of energy. Companies do not have that. They are in a huge shortage. So when you say, oh, this is very deflationary, yes, it is, but it's not on a broader scale. It doesn't bring down any of the major line items that are causing most of the pain to the average consumer right now. These are items that have very high resilience to demand shocks because people need them to survive, and these are items that actually need an increase in the supply chain to really recover from, which that ain't happening anytime soon, right? Next, you have Shopify coming out and saying, hey, we are going to lay off 10% of our workers. E-commerce isn't growing as fast as we thought, and really the whole e-commerce boom is just completely dead. A lot of analysts are now starting to think, hey, wait a second, maybe even 2019, 2018 numbers for e-commerce are going to be much better than anything we're going to be seeing for the next year. Microsoft certainly came in pretty soft. Another pretty bad report. The strengthening dollar as compared to other currencies has been gutting their profitability alongside inflation and what they cite as a deteriorating PC market. You think about all the big corporations that were expanding and booming in 2021, looking for huge demand increases for the next 5 to 10 years. Well, they were all expanding and buying more and more PCs. Now, nobody wants to invest in this economy. If you're a company, especially a tech company that's looking to expand, what do? Go and hire a bunch of workers workers, you go and get some new land, so on and so forth. Right now, the opposite is happening. People are saying this is not the kind of economy I want to grow in. This is not the kind of economy that I want to bet on. But in terms of the stock price, I mean, you kind of look at how this trades. You have this dynamic where a lot of these mega caps are down 20, 30% already. And if you're a fund manager, you're kind of like, well, what do I do? Do I go all the way into cash and just tell my investors that I give up? Or do I strategically buy back in on dips when these earnings reports come out? Because obviously we know in the long run, Microsoft's going to do fine. And at the same time, markets are already expecting the Fed to start cutting rates Q1 of 2023 at the latest. Right now, you're in this environment where fund managers are like, hey, if I'm holding clients' money in cash and the Fed decides to reverse course and they're already being a little baby as is, then all of a sudden I'm going to be holding an asset, cash, that depreciates a lot faster than it even is right now. That is probably going to be stuck melting at a higher baseline than it has been the last 20 years. So I think strategic dip buying is what you're seeing in a lot of mega cap names right now. Let's go over to Alphabet. Alphabet missed on both earnings and revenue for the second quarter, and expectations were low, but I mean, their actual results weren't a complete disaster. This is another company where people like to hide out in. However, revenue growth was 62% a year earlier. Now it's at like 13%. Clearly very, very big slowdown. And this is one that really didn't have much of a slowdown in 2020 and actually benefited quite a lot in 2020. So it's like you're coming off of like 10 years of really, really strong growth. You look at literally every line item though, from EPS to again, overall revenue to YouTube advertising revenue to Google Cloud revenue, even the lowest of expectations, Alphabet just couldn't seem to beat. But it wasn't just a completely drop dead report. Kind of like, hey, we tried to shoot for a basket that was 4 feet high and we didn't make the basket, but we hit the rim, so that's good enough. But looking at Walmart's numbers, looking at e-commerce activity overall, and looking at Alphabet's cloud computing results suggests to me that Amazon is in for a rude awakening on Thursday. You already saw them announcing that they were hiking Prime membership prices in Europe by 43%. If that doesn't scream, oh, I'm having inflation problems, I don't know what does. Now let's talk about Visa. There's nothing quite like the credit card company business, right? You get a percentage fee, so it's like, oh, who cares if consumers are spending more money on this category or that category or this category? We're still getting an overall percentage fee. So as long as more money is flowing through the system, inflation or not inflation, then boom, cha-chinga. Obviously, some areas of spending are more lucrative than others, but overall, I mean, Visa tends to be one of the best players in an inflationary environment. When they start doing bad is when you get into an environment where overall consumer spending is expected to get crunched. You look at the stock and the reaction to earnings today, I mean, this is one example of people looking at the original numbers and being like, damn, those are pretty damn good. But then they're thinking, well, what comes next? What kind of environment are we heading into? Are we heading into one where people are going to have more and more money to spend? Are we heading into one where people are going to travel more and more, which is Visa's favorite business model? No, we're heading away from those environments. We're heading into more and more crunching. We're heading into environments where it costs more money to borrow. So it's like you have that original positive reaction and then boom, people start factoring in the macro headwinds, right? But overall, I mean, I think what you're really starting to see here is the beginning of a massive earnings recession, the earnings recession that Michael Burry was talking about. The biggest problem in the future may not be multiples, it may actually be the earnings, which is the core of the multiple, right? Because valuations are earnings times multiples, right? So once the multiple crunching's over, if you actually get crunched from earnings, all of a sudden, boom, that's a big drop as well. And when you see companies like Walmart start reporting that the consumer is being gutted, the most core consumer that shops at Walmart, the most important consumer, the middle class of the American economy, when they're starting to see all of a sudden, I don't have as much money to spend. All of a sudden, I can't buy even things at Walmart that I want. That's when you know that you have a lot of bad things coming for the rest of the players in the overall economy, right? And that's going to ripple through as we head into the end of the year. Anyway, some interesting things to think about heading into the FOMC meeting tomorrow and the Fed rate hike decision tomorrow. I guess technically the meeting started today, but we're going to get the announcement tomorrow. So we'll stay tuned and I'll keep you updated if I see anything new. Anyways, that caps off this video. Make sure to help ward off a recession in your own account by getting your 10 free stocks with Moomoo down below. If you want to learn how to trade with our step-by-step lessons, private chat, daily morning briefings, as well as our full price target list, I'll put a link to ZipTrader you below as well. Have a good one, folks, and I'll see you in the next video.